Wall Street just made a $766 million mistake with CleanSpark. While every analyst is busy comparing Bitcoin miners like they're all the same commodity play, they completely miss that CLSK isn't a mining company anymore. It's an energy infrastructure empire sitting on $1.2 billion in Bitcoin Treasury, 1.45 gigawatts of owned power capacity, and a 0% interest financing deal that just handed them over $1 billion to execute the most asymmetric AI pivot in the sector. The numbers don't lie. CleanSpark trades at a 13.1 times PE ratio while holding more Bitcoin than Marathon Digital, more infrastructure than Riot platforms, and achieving 55% gross margins that would make software companies jealous. And the market is pricing this like it's just another miner. That changes today. By the end of this video, you'll understand exactly why the smart money is accumulating CLSK while retail is chasing the wrong tickers. And more importantly, what happens when the market finally wakes up to what CleanSpark actually is. Let's break down the numbers that Wall Street refuses to see. Here's what 99% of investors get wrong about CleanSpark. They think it's a Bitcoin mining company. It's not anymore. CleanSpark is an energy infrastructure company that happens to mine Bitcoin as its baseline revenue stream, while building the physical assets, land, power substations, data centers that will serve the AI revolution. This isn't speculation. This is exactly what CEO Matt Schultz outlined in the November 2025 earnings call. Think about it. What does an AI data center need? Gigawatt scale power, low latency fiber, grid interconnection, cooling infrastructure, permits and land control. You know what Bitcoin miners already have? All of that. And CleanSpark has more of it than almost anyone in the sector. While competitors like Marathon and Riot are still figuring out if they want to pivot to AI or stay pure Bitcoin plays, CleanSpark has been quietly executing a hybrid strategy that gives them downside protection through profitable mining and upside optionality through infrastructure that can serve AI customers at 10 to 25 times higher. Revenue per kilowatt. This is the setup. Wall Street hasn't priced in yet, and when they do, the valuation gap closes fast. Let's talk numbers because this is where the story gets insane. CleanSpark just closed fiscal year 2025. That's the 12 months ending September 30th, 2025, with revenue of $766.3 million. That's 102% growth. They literally doubled revenue year over year. But here's the kicker. They did this after the Bitcoin halving in April 2024, which cut block rewards in half. Every miner on the planet saw revenue compression from the halving. CleanSpark scaled operations so aggressively they more than compensated for it. Now look at profitability. Fiscal year 2024. CleanSpark lost $145.8 million. They were bleeding cash while building infrastructure. Fiscal year 2025. They made $365 million in net income. That's a $510 million swing in 1 year. Pull up that chart. Look at those bars. This isn't incremental improvement. This is operational leverage kicking in at massive scale. And the gross margin? 55.2%. That's not commodity mining margins. That's infrastructure business margins. Operating expenses dropped from $362 million to $104 million because the infrastructure is built. They're not in expansion at all costs mode anymore. They're in harvest mode, printing cash while strategic competitors are still raising dilutive equity. Now, let's talk about the elephant in the balance sheet. Bitcoin. As of November 2025, CleanSpark holds 13,054 Bitcoin. At $90,000 per Bitcoin, and we're seeing prices push toward $100,000, that's approximately $1.2 billion in Treasury assets. But here's what makes CleanSpark different from MicroStrategy or other Bitcoin Treasury companies. They're mining this Bitcoin at a profit, not buying it with debt or equity raises. Every Bitcoin they mine is produced at an energy cost dramatically below market price because they own the power infrastructure. Check out this balance sheet breakdown. Total assets grew 62% from $1.96 billion to $3.18 billion. Bitcoin holdings grew 172% in value. But notice something critical. They didn't dilute shareholders to get there. They mined it and they bought back shares. $460 million in share buybacks during fiscal 2025. They reduce share count by 10.9% while accumulating Bitcoin. That's fortress balance sheet construction, not financial engineering. This Bitcoin isn't just sitting there, it's collateral. CleanSpark has a $400 million credit facility with Coinbase Prime backed by Bitcoin. That means they can borrow against their treasury at favorable rates without selling Bitcoin or issuing equity. This is strategic capital allocation. In November 2025, CleanSpark closed one of the most brilliant financing moves I've seen in the mining sector: $1.15 billion in convertible notes. But not just any debt, 0% coupon. Let me repeat that. They borrowed over $1 billion and they pay 0 interest. The notes don't mature until 2032. That's 6 years of free capital. Here's how convertible notes work. Investors buy debt that can convert into stock at a premium, in this case 27.5% above the offering price. So if CleanSpark's stock appreciates beyond that conversion price, bondholders convert to equity. If it doesn't, CleanSpark just pays back the principal at maturity with no interest burden. Compare this to competitors raising equity at 12 to 15% dilution or issuing traditional bonds at 8 to 12% coupons. CleanSpark is playing a different game. They're using the lowest cost capital in the sector to fund the highest return infrastructure buildout. And what are they doing with this capital? $460 million in buybacks, already done. Another $300 to $400 million earmarked for expanding their power portfolio from 1.45 gigawatts to 2.7 gigawatts. $100 to $200 million for AI data center development. The rest goes to debt repayment and operational flexibility. This is textbook asymmetric capital allocation. Maximum optionality, minimum cost, 0 interest drag. Let's get tactical about the physical assets because this is where CleanSpark separates from the pack. 1.45 gigawatts of contracted power capacity across 33 sites in Georgia, Texas, Wyoming, and Arkansas. 808 megawatts, currently energized and producing revenue. 642 megawatts in the deployment pipeline, meaning land acquired, permits secured, contracts signed, just waiting to flip the switch. Here's the expansion roadmap. They're targeting 2.7 gigawatts total capacity by late 2026. That's nearly doubling their power portfolio. And every megawatt they add has dual use capability: Bitcoin mining or AI data centers. Here's why that matters. Bitcoin mining generates about $500 per megawatt hour in revenue at current prices. AI data centers generate $5,000 to $12,000 per megawatt hour. That's 10 to 25 times higher revenue density. But AI data centers require continuous uptime, 99.99999% reliability. Bitcoin mining is interruptible. You can shut it down during grid stress events and redirect power to utilities or high-value customers. CleanSpark's CEO explained this perfectly. Blending Bitcoin mining with AI data centers gives utilities the load, flexibility they desperately need while giving CleanSpark the revenue stability they want. During Hurricane Helene in 2024, CleanSpark shut down mining operations in Georgia and redirected power to the grid, helping a hospital restore power within hours. That's not just good PR, that's proof of concept for grid interactive infrastructure that utilities will pay for. Now we get to the asymmetric opportunity: AI infrastructure. Global AI data center demand is projected to exceed 40 gigawatts by late 2025. The problem? There's not enough power, not enough land, and not enough time to build traditional data centers. Interconnection queues with utilities are backed up 2 to 5 years. Bitcoin miners don't have that problem. They already jumped the queue. They own substations, they have energized power contracts, they control land, they've built cooling infrastructure. All they need to do is swap mining rigs for GPU clusters and sign hyperscaler contracts. And we're already seeing the precedent. Iran Limited announced a pivot to 23,000 NVIDIA GPUs and signed $225 million in AI contracts. Their stock surged over 300%. Core Scientific got acquired by CoreWeave for $9 billion. Applied Digital signed a 250 megawatt lease worth $11 billion over 15 years. Look at this peer comparison. CleanSpark holds more Bitcoin than Marathon and Riot. They have comparable or superior power capacity. They're trading at 13.1 times PE, while Riot trades at 29 times. But here's the critical difference. CleanSpark owns their infrastructure. Marathon and Riot lease significant portions. Ownership means CleanSpark captures the full arbitrage when they pivot megawatts to AI. No landlord taking a cut, no lease renegotiations, no counterparty risk. CleanSpark has already announced they're developing 100 megawatts of AI data center capacity in the Atlanta metro area. That's just the beginning. If they convert even 250 megawatts to AI at conservative $5,000 per megawatt pricing, that's $1.25 billion in incremental annual revenue at 70 to 80% gross margins. Do the math. That's nearly $900 million in gross profit from AI alone, on top of existing mining operations. And they can fund this with zero interest debt. Let's talk about why CleanSpark at a 13.1 times PE ratio is borderline absurd. Software companies trade at 30 to 40 times earnings. Even commodity-exposed companies in energy infrastructure trade at 18 to 25 times. CleanSpark, with 55% gross margins, a $1 billion Bitcoin treasury, owned infrastructure, and an AI pivot runway, trades at 13 times. Here's the waterfall. Bitcoin treasury at $95,000 per coin, $1.24 billion. Add operating infrastructure assets conservatively valued at $1.5 billion. Subtract the $1.15 billion in convertible notes. You get $2.59 billion in net asset value. Current market cap? $4.12 billion. That means the market is valuing future AI optionality, growth, and execution at about $1.5 billion, roughly 36% of market cap. That's not expensive. That's cheap for a company entering a market with 10 to 25 times revenue arbitrage potential. If CleanSpark executes even half of their AI roadmap, we're looking at a business worth 8 to 12 billion. In 26 to 27, that's not hype. That's what happens when infrastructure assets get re-rated from commodity mining multiples to AI infrastructure multiples. Now, let's be real about risks, because no investment is perfect. Bitcoin could crash below $60,000, that would hurt sentiment. But CleanSpark remains cash flow positive at those prices due to their low energy costs. AI hosting margins could compress if competition floods the market. Possible, but CleanSpark's owned infrastructure gives them the lowest cost structure. Execution could be delayed, sure, but they've already proven they can energize facilities in 5 weeks faster than any competitor. The biggest risk? The market continues to misprice them as a commodity miner and ignores the infrastructure value. That's actually not a risk if you're patient. It just means more time to accumulate at discount prices. Smart money positioning for 2026 looks like this. CleanSpark is a 1.5 to 4% portfolio weight for asymmetric upside. It's not a speculation, it's a calculated bet on infrastructure revaluation backed by tangible assets, profitable operations, and fortress balance sheet. Here's what to watch in 2026. Q1. AI data center partnership announcements. If CleanSpark signs a hyperscaler contract, Google, Meta, Microsoft, expect 15 to 25% immediate re-rating. Q2. First AI customer revenue hits the income statement. Precedent from IREN and Applied Digital suggests 30 to 50% stock moves. Q3. 500 megawatts additional power capacity goes live. Operational execution proof. Q4. AI facility ramps to profitability with 70+% margins. That's when the market fully re-rates from miner to infrastructure platform. Bull case. Multi-gigawatt AI partnerships drive market cap toward 8 to 10 billion. Base case. Steady execution keeps them compounding at 20 to 30% annually. Bear case. Bitcoin crashes and AI pivot stalls. But even then, profitable mining and Treasury provide $10 to $12 per share downside support. So here's my final question for you. Do you think CleanSpark is the most undervalued opportunity in the Bitcoin mining space right now? Or is there something I'm missing in the analysis? Drop your thoughts below. If you disagree, tell me why with data. If you agree, tell me what price target you're seeing for 2026. Subscribe, because next week we're breaking down another completely mispriced opportunity the market is sleeping on. Hit that bell so you don't miss it. This is not financial advice, this is financial education. Do your own research, consult professionals, and never invest money you can't afford to lose. I'll see you in the next one.